In 2018, this company was posting the best earnings in Korean history, one record quarter after another. But its stock? It had already peaked 5 months earlier and was falling. Earnings at an all-time high and the stock collapsing first. Why? Today, another company stands at that exact question. SK Hynix. So, is SK Hynix stock a buy? Right now, it's one of the most profitable chip companies on earth, #1 in HBM, with quarterly operating margins above 70% and a brand new listing on the US Nasdaq. But to judge this stock, you only need to understand one thing about memory. It's cyclical, and understanding why memory is cyclical is the whole game. Cyclical means earnings rise and crash in waves, over and over. It's like surfing without knowing the wave cycle. Catch it right, and it's life-changing. Miss it, and you get slammed into the seabed. So let's figure out exactly where this wave is right now, in a way anyone can follow. First, the scorecard. Based on official filings, in the first quarter of 2026, revenue was 52 trillion won, operating profit 37 trillion won, and the operating margin was 72%. That means for every 100 won of sales, 72 won was profit. For comparison, Nvidia runs around 60%, TSMC around 47%. This company out-earns even Nvidia on margin. But here's the twist. Just 2 years earlier, in 2023, it posted an operating loss of 7.7 trillion yuan. A loss. In 2 years, it went from -7 trillion to +37. Normal companies don't move like this. This is what it looks like when earnings go, in a sense, insanely out of control, and the reason is one word: cyclical. Let's picture it. Take the classic cabbage farm analogy, but with one condition. Not just anyone can grow this cabbage. Only 3 companies on the planet make it: Samsung, SK Hynix, and America's Micron. So imagine just 3 golden cabbage farms in the whole country. Building a new one costs billions and takes years, so no one else can get in. You'd think these 3 would keep prices high and coast, right? The opposite is true. Because there are only 3, when one says demand is exploding, let's expand, the other 2 expand too, terrified of losing share. A few years later, all 3 harvests flood the market at once, and prices collapse. The industry calls this a game of chicken. And here's what beginners get wrong most. A high barrier to entry and stable prices are 2 completely different things. The gatekeeper can be fierce, but if the 3 already inside all ramp up at once, prices still crash. An oligopoly doesn't kill the cycle. It makes it swing harder. Words aren't enough, so let's use numbers. Here's the combined operating profit of Samsung's chip division and SK Hynix. 2018, about 65 trillion won. A memory supercycle, peak boom. Then 2019, it collapses to the 16 trillion range in a single year. 74% gone. 2021, a pandemic bump back to 42 trillion, and 2023, minus 22 trillion won. A loss. 65 to 16 to 42 to minus 22. Is that the earnings chart of a normal company? No, that's a heartbeat monitor. And here's the decisive part. In 2023, during that loss, it was still the same 3-way oligopoly. Samsung, SK, Micron, no new entrant. And yet all 3 lost trillions together. That is the death certificate for the idea that an oligopoly is safe. In fact, this industry once had dozens of players. But the game of chicken got so brutal that Germany's Commanda went bankrupt in 2009, and Japan's Elpida in 2012. Today's 3-way oligopoly didn't form because the cycle disappeared. It formed because the cycle was so vicious the weak ones died. One more. In the 2018 supercycle, Hynix's stock peaked in May, but the company's operating profit kept setting records for 3 more quarters after that. Earnings kept breaking records, yet the stock had already topped out 5 months earlier and started falling, down about 40% in 8 months. Remember the question from the opening? The stock leads the earnings. Why that happens becomes clear once we see what this company sells, and the trap hidden in its valuation. So what exactly does this company make? Let's lay the groundwork. SK Hynix makes memory chips, and memory comes in 2 kinds. DRAM is the temporary workspace your computer uses right now. The bigger the desk, the more you can spread out. Cut the power, and it's all gone. NAND is the warehouse that stores data. It survives a power off, and it's what's inside your SSD and USB drive. But the thing that turned this company into a superstar is something else: HBM. HBM stacks DRAM in layers to push data transfer speed to the extreme. It sits right next to AI chips, Nvidia's GPUs, trading enormous amounts of data at high speed. To run an AI like ChatGPT, data centers need mountains of it, and SK Hynix effectively dominates the HBM market. As of the second quarter of 2025, share is estimated around 62% for SK Hynix, 21% for Micron, and 17% for Samsung. It's beaten proud Samsung by more than 3-1. HBM sells for 5 to 10 times the price of regular DRAM, and selling the most of that expensive product is what pushed the operating margin to 72%. So why are earnings going wild right now? Picture those 3 golden cabbage farms again. Suddenly, the whole country starts making kimchi like mad. That kimchi is AI. Since ChatGPT, every big tech company on Earth has been pouring money into AI data centers, and those centers swallow enormous amounts of memory, especially HBM. Demand explodes, but supply can only grow at the speed of building factories, so prices shot up like a rocket. Look at the numbers. In the first quarter, the average selling price of DRAM jumped by the mid-60% range in a single quarter, and NAND by the mid-70s. They didn't sell more units. They sold the same units for far more. That is the real secret behind that 72% margin, and right now, the inventory is sold out. The memory to be produced in 2026 is already spoken for, locked up years in advance by big tech under long-term contracts. But here's the trap. Today's earnings were built by price, not volume, and earnings built on price collapse when price collapses. So what about the next few years? Let's take the analyst consensus as it stands. As of July 2026, SK Hynix's projected annual operating profit is about 265 trillion won for 2026. A year ago, that estimate was 39 trillion. It's been raised more than sixfold. For 2027, the consensus is about 386 trillion won, and aggressive houses like KB Securities call for 454. To put that in perspective, that is more than Microsoft and Google's operating profits combined from a single chip maker. But there are 2 things you absolutely must catch. First, the consensus bends downward in 2028. The 2028 estimate for SK Hynix is about 383 trillion won, down 0.8% from the year before. Samsung's is seen falling almost 6%. In other words, the market's own average forecast already draws a peak out in 2028. Why 2028? Because the 3 companies have started a $500 billion wave of expansion, and those new factories begin flooding the market with product around 2028. All 3 farms are plowing new fields at the same time right now. Second, the spread between analysts is enormous. For the very same 2026 operating profit, Nomura calls about 99 trillion, Mirai Asset 148, Daishin 204, and KB 280. The lowest and the highest are nearly 3 times apart. What does that tell you? That nobody is sure. For a cyclical, even the experts disagree by 3 times. Now this is the heart of it. Stay with me. SK Hynix's price-to-earnings ratio, its share price divided by its earnings, is around 6 to 8 right now. A lower PE usually looks cheaper. Micron sits around 7 to 9, so Hynix actually looks cheaper. That's where the calls of undervalued, time to buy come from. But there's a trap. In a cyclical stock, a low PE is often a danger sign. Call it the low PE paradox. Here's how it works. The PE ratio is price divided by net profit. Right now, Hynix's net profit has exploded to record highs. When the denominator gets huge, the PE automatically shrinks. So the PE is lowest exactly when earnings are at their peak. The reverse was true in 2023. With losses, net profit was negative, so the PE couldn't even be calculated, or it spiked into the hundreds. And that was the bottom for the stock. So, put it together. Best earnings mean maximum profit, which means the lowest PE. It looks cheapest, but it may actually be the top. Worst earnings mean the highest PE. It looks most expensive, but it may actually be the bottom. Take the ordinary rule that a low PE means cheap, apply it to memory, and you can end up doing the exact opposite of what you intended. A cyclical isn't read by its PE, it's read by where you are in the cycle. And that is the answer to our opening question. The stock fell first because the market prices in the cycle's next direction, not today's earnings. There was one big event recently. In July 2026, SK Hynix listed on the US Nasdaq, specifically as an ADR, where Korean shares are held by a US depository and traded in dollars. The scale was huge. According to reports, it raised about $26.5 billion, roughly 40 trillion won, the largest listing by a foreign company in US history, surpassing Alibaba and Saudi Aramco. On the first day, the stock jumped, and its market value briefly passed Micron's. Why go to Nasdaq? Two reasons. First, the cash goes into expanding HBM. Second, escaping the so-called Korea discount. American investors get easier access, and index inclusion pulls in ETF money automatically. But here's the irony. For all that fanfare, the domestic stock had fallen about 40% from its high around the listing. The listing wasn't a catalyst up, it became a textbook trigger to sell the news. Good news is not always a good stock price, and this was one more reminder. We've said a lot of good things, so now the other side. This part matters most, because this company's source of blessing is also the seed of its curse. There are 5 risks. 1, it's still cyclical. However much the world has changed with AI, memory is memory. Every supercycle in history came with someone saying, this time is different, and not once has it escaped the cycle. 2, Samsung's counterattack. Hynix leads in the current HBM3E generation, but the next generation, HBM4, could shake the board. One brokerage estimates Hynix's HBM4 share falls to around 55% as Samsung climbs. There's even talk that AMD named Samsung as its HBM4 supplier for a next-generation chip. When the monopoly cracks, the margin cracks. 3. HBM is still made from DRAM wafers. This is the part bulls rarely mention. HBM lines and commodity DRAM lines share the same factory capacity. Right now, everything is funneled to HBM, but if HBM demand cools and that capacity swings back to commodity DRAM, it becomes an oversupply bomb. 4. The AI bubble debate. This whole story assumes big tech keeps pouring money into AI. But in July 2026, when Meta said it would sell spare AI computing capacity to outsiders, the market read it as a sign of slowing AI investment and knocked chip stocks around. If AI spending disappoints, today's sold-out streak can turn into an inventory bomb overnight. 5. A single business structure. Hynix is essentially memory only. Samsung has phones, appliances, and displays to lean on if memory dies. Hynix falls when memory falls. In a boom that focus creates explosive upside, but in a bust, there's no cushion. The 7 trillion won loss in 2023 is the proof. So here's the real debate. First, one thing to settle. Whether memory is cyclical is not up for debate. That's settled fact. The real question is whether this cycle has structurally flattened, or whether it's just a bigger swing that still crashes like it always has. Listen to both sides. The it's milder camp. HBM really is a different product from old commodity DRAM. From HBM4 on, it's closer to custom design, hard for anyone to make, and long-term contracts lock in volume and price, so it's less exposed to spot price swings. That is a genuine cycle smoothing factor. Hynix's leadership and Nvidia's Jensen Huang both say the AI memory shortage lasts for years. The other camp, they said that before. In 2018 and again in 2021, people said, this time is different, and every time they were wrong. The 3 companies are pouring $500 billion into expansion, and the problem is 2028, when that supply arrives. Long-term contracts aren't gods either. When the cycle turns, renegotiation begins and contracts shrink. Weigh it honestly, and still cyclical wins by roughly 6-4, even 7-3. But the bulls can't be dismissed. HBM being different is a fact, and long-term contracts really do dampen the swing. So the question to judge isn't whether the cycle is gone, it's whether the higher the peak, the deeper the trough, or whether this time the descent is gentle. That is where the real money is riding. Let's wrap up. SK Hynix is a company at the absolute peak of its life right now. Number 1 in HBM, margins above 70%, a Nasdaq listing, more orders than it can fill. All of that is real, but the nature of this company hasn't changed. It's cyclical, a company that rides waves. The three-way oligopoly makes the barrier high, but that same oligopoly creates the game of chicken that makes the cycle swing even harder. All three losing money together in 2023 is the proof. This wave is clearly enormous. The question is whether it's just starting to rise or already near its crest. The consensus draws a peak in 2027 and a decline in 2028, which means the market already knows the party ends someday. So for anyone seeing this stock for the first time, 2 takeaways. First, Hynix is not a stock you buy because it's cheap. Don't be fooled by a PE of 6. In a cyclical, that can be a sign of the top. Second, don't be fooled by safe because it's an oligopoly either. That oligopoly did not stop the losses of 2023. This stock isn't a valuation game or a monopoly premium game. It's a game of judging where you are in the cycle. The wave always breaks. The only question is whether you have a plan to get off before it does. Nothing here is a recommendation to buy or sell any stock. It's an educational breakdown to understand this industry. All figures are based on filings and brokerage consensus and change over time, and cyclicals are exactly where consensus is wrong most often. Your decisions and their consequences are always your own.